How's it going, guys? Are you tired of boring old testimonies on congressional hearings? Like, where are all the pictures, am I right? Get out of here, Grandpa. Well, you are in luck. We are looking at Sal Arnook's testimony right here. It has pictures, it has analogies of stock options with fruit and with coupons. And look at TD Ameritrade. We got people jumping into a pool. This is a pretty damning expose of payment for order flow and exactly why Robinhood, Webull, and all these other brokers are free. It's because they need to take that tiny delta of you making your order on your app entirely free, by the way. It used to cost a couple of like $20+, maybe even cost hundreds of dollars to make an order because a broker needed to make a small commission on top of every single buy and sell. Now it's entirely free. Why is that, and why is that starting to destroy the markets and hurt the economy in an irrevocable way? This person is a co-founder of Themis Trading. His name is Sal Arnook, and he is going to be testifying in front of the congressional hearing, which I am going to be live streaming with Professor Meatball tomorrow all day. So make sure you tune in and subscribe to the channel because it is going to be a doozy. Here is their thesis. Themis's thesis. They believe the most damaging elements of what has become a meme stock craze are playing out because of A, extremely poor investor education, and B, conflicts of interest in the form of order routing inducements, referred to as payment for order flow, PFOF, and a lack of accountability for poor investor education and misaligned incentives. At the end of the day, this is the biggest casino in the world, and if the incentives don't make sense, right, people are going to get hurt. And why is Robinhood incentivized poorly or even maliciously? Let's talk about, let's just go stroll way down here, boom, 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 and talk about the undeniable conflict of interest right here. When investors make a trade, they incur costs both explicit and implicit, right? You guys make a trade and you suddenly have to ride this casino all the way up or all the way down. That is the explicit cost, but there's an implicit cost too, something a little more devious and a little more dastardly. Payment for order flow may enable zero commissions, that's why it's free, but while that explicit cost is zero, other larger implicit costs dwarf it. Payment for order flow is legal, but we have long wondered why. Why is it legal at all? How can a broker charged with the duty of getting its clients the best available prices, which they are supposed to do, right? Get you the best prices to buy and sell the stock, possibly do so by selling your clients' orders information to amazingly sophisticated high-frequency trading firms, HFT firms, who in turn will make billions of dollars trading against these orders. Yes, they are trading against your orders by learning about your orders microseconds before you make them. While retail brokers and market-making firms claim that price improvement, PI, accrues to retail investor orders, such price improvement is a flawed calculation. Number one, it's based off of a slower price feed, the SIP. Number two, it does not take into account odd lots. Number three, the NBBO reference price it uses is largely set by the very same high-frequency trade market makers providing the PI in the off-exchange environment. There is just too much conflict of interest right here. They are incentivized basically in the exact same way as the people trading directly against you. Regulators know all of this. The SEC recently fined Citadel $22 million for mishandling retail orders. You know that that's probably one of the reasons why Citadel is looking for $600 million in bonds. They just started asking for handouts. Do you want to give Citadel free money after they keep doing these shenanigans? They also recently fined Robinhood $65 million, failing its best execution responsibilities. They know that the concept of PI is flawed. They approved a huge market structure change, which includes odd lots in the SIP, and protected them as a quote. Yet our industry sued the SEC to block this overhaul. PFOF increases overall costs in the market. Payment for order flow increases overall costs in the market for all investors, including pension funds. It makes it more expensive for all of us to be in this market. Back in 2012, we wrote a book called Broken Markets. Oh, it's a big plug for their book right here, in which they asserted that for a true price discovery to take place, exchange limit order books need diverse players in them. Does it sound like what we just described, the relationship between the high frequency trading and Robinhood and these other brokers? Does that sound like they are actually diverse? Does it sound like they are actually aligned in the same direction, or malaligned together in bad incentives? Thank you, DW. Let's give Meatball a treat, actually. So, a little treat break, and now right back into the text. The pictures are coming in a second, don't worry. When a few HFT market makers buy up orders that account for as much as a third of the volume, orders that tend to be less informed, uncorrelated, and benign, like the regular retail investors that buy and sell trades, they're not trying to like hurt a stock. They're just saying, hey, I think I like Tesla. Boop, 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 I just bought some Tesla. They're not trying to short the stock. They're not trying to do call and put options against it, trying to hurt the stock in any way. They're just trying to buy and learn, just like you guys. You're educating yourselves. Hitting that subscribe button is the best way to start educating yourselves right away. What is left on those exchanges is that much more toxic and costly to trade with. Market impact costs are higher and spreads are wider as well. Two studies that confirm this are the Babelfish study of transaction costs in meme stocks and additional academic study that amazingly points out that when Robinhood experiences technology outages, spreads in the general market become narrower. Wider spreads mean that the retail investors receive worse prices, even after accounting for PI, and all other investors see their costs increase as well. You see that this is starting to double down on the idea that this is bad for everyone, not just some. Okay, PFOF, payment for order flow practice, provides a disincentive for displayed limit orders on exchanges. These displayed orders are often stepped in front of by HFT market makers who piggyback the price set by them. Those market makers step in and are rewarded with a sale that was only made possible by the displayed order, which narrowed the spread. Would any of you, when buying a home, for example, put a sign out front of said home with the price you would pay only to help someone else buy the house ahead of you for the same price or $1 more? Yet this is exactly what happens to displayed prices in the market every day. That's a fantastic analogy, by the way. You guys are essentially saying, hey, here's the price that I would buy for this stock when you buy a stock on Robinhood. That tells the entire market your willingness to pay right away. And that is the millisecond difference that PFOF takes away from you. PFOF also takes the form of a maker-taker on exchanges. This practice creates race conditions to be first in line to get a rebate every time a quote changes in the marketplace. These race conditions are the goal of the exchanges. After all, they sell the tool and speed needed to compete in them. The races are not so good for everyone else as they encourage high costs, games, and complexity. It should surprise no one that investor orders do not dominate these races. HFT market makers do. Investors' orders typically find themselves further back in the queue. As a result, investors miss opportunities at buying cheaper stock, and when they do get filled, they are subject to outsized adverse selection. Despite this, brokers representing investors still route largely to these exchanges for that rebate. So once again, they are essentially making too many roles in this game where we need a diverse selection of people to actually make sense of this crazy market. Regulators know this behavior is conflicted and distorted. In December 2018, the SEC adopted a transaction fee pilot whose purpose was to test the effect of rebates on market quality. Sadly, the exchanges sued and succeeded in blocking the pilot. What were the exchanges afraid? That the pilot would confirm. Finally, maker-taker on exchanges has dramatically increased fixed trading costs to trade on the exchanges. This has resulted in less diverse public markets, which is especially undesirable from a price discovery perspective. Which of the following markets would have made a better price discovery? A, one where the prices are determined by an oligopoly of 4 large high-frequency trading firms. Does that sound like an oligopoly? Does that sound like something that would be fair and equitable? Or 2, one where the prices are determined by diverse participants, retail, institutional, A or B players, as well as numerous HFT trading firms. We're not saying that they can't exist. We're just saying that they shouldn't exist. They shouldn't be the only ones that are making the plays, right? They shouldn't be the only ones there. The reason why I'm scrolling back up is because I do want to be able to read this section before the conclusion, right? Here are the pictures, like I promised. Investor trader education. This is where all the pictures are coming from. When people are being educated by the stonks, it ends up being a little bit childish, a little bit infantile, and a little bit dangerous. Investor Trader Education. Robinhood does something very novel. They combine investing and trading tools with the social media experience targeted to young people, youthful people, complete with trading addiction and a herding effect. They have amassed a user base whose orders tend to be small. For example, Robinhood's average account size is about $5,000 compared to TD Ameritrade's, which is $110,000. Let's get some scissors in the chat if you have less than $5,000 in your Robinhood account. Of course, all of you should have quit Robinhood already. And let's get some stones or rocks in the chat if you guys have more than $110,000 in your TD Ameritrade apps. As such, they have created a unique product, small emotion-driven orders that tend to be predictable, which they can then sell to their real customers, HFT market-making firms, at a premium. If you think this claim is bombastic, consider that one. Prior to starting Robinhood, the founders developed HFT platforms for the largest financial institutions in the world. 2, they recently changed their PFOF method from one giving them a set payment per share to one giving them a percentage of the spread instead. Now they're directly incentivized to make that spread. A Robinhood trader, you essentially, someone who, like Courtney Vickery, who just joined as a special infantry operations group of the Mo Monkey Army, you are trying to get the best price possible, the lowest spread possible. But now, though Robinhood benefits most when the spread is as wide as possible as well. This is an amazing misalignment of interest. They want to give you a bad price. Robinhood turned down market maker offers of PI for its app users, opting for a larger payment for its own bottom line instead. And Robinhood has garnered $13 to $20 billion of valuation, with its largest revenue source being payment for order flow, which means that its founders' personal wealth is derived from customer trading and more PFOF, even if the trading is potentially not in the best interest of its customers. They make almost all their money directly from giving you guys not a great price. That's a really important note. This tells you that Robinhood knows full well the value of its herd and gamified product base. They knew to educate their users just enough to incentivize trading and maximize their own revenue as a result of it. We have included exhibits B and C as examples of options trading education from Robinhood and TD Ameritrade for you to compare, draw your own conclusions. The incentive that has enabled their model is none other than payment for order flow. Once again, paying a company money, the high-frequency trading company's money, so that they can use your data. So let's look at Robinhood and see finally the pretty pictures of what this hilarious analogy is. Hey, this is February 23rd. This was just a couple weeks ago. This is way after the January squeeze, by the way. Okay, hold on. This fruit is getting too big. Robinhood learned what is a stock option. Stock options are like growing fruit. It's an old Bulgarian tale, says Free Ricky before. You hope the seeds turn into something that can be picked at harvest. If the fruit is inevitable, you lose the cost of the seeds. If the fruit is ripe, you have the option to pull the fruit off the tree. Oh, sweet. Trey says, want to go live in like an hour and a half or so. So therefore, I guess I'll be back in an hour and a half after this video. So what does this mean? Well, essentially, this is trying to say, I'm gonna say yes to Trey. This is trying to say that the premium you pay is the seed cost, even though it's $100 per option. Sorry, it's 100 times that premium per option. So it's a lot of seed that you could lose if the fruit is inevitable. So that is that's pretty messed up. That's pretty messed up. It's just making it seem like a little game here. And then we have over here, what is a call option? For sale ASAP. This doesn't even look like a coupon. This is a bunch of boats. So we have call options are like a grocery store coupon. They give you the right to buy a specific item for a certain price before the coupon expires. However, if you find the same item at another grocery store for cheaper, you probably won't use the coupon. Call options are just coupons. Call options are like grocery store coupons. This was March 11th, 2021. Someone just wrote this and is making it seem like one of the most risky bets in the entire market is just buying a coupon. And finally, what is a put option? Well, buying a put option means you have the right but not required to sell the security at a specified price for a set time. Seems like one of these, March 11th. Remember, these are both updated the same day. Seems like Robinhood wants you to do one of these a lot more than the other one. This one is literally just the technical definition. This one is about a coupon. What the heck? Now let's compare this to Exhibit C, TD Ameritrade samples. Okay, so now this is TD Ameritrade option statistics. Refine your option strategy with our option statistics tool. Look at the put-call ratio to identify the potential direction of the underlying security, assess the IV percent to determine a buying or selling strategy, and use our sizzle index to help identify if option activity is unusually high or low. Yes, very, very technical, possibly restrictively so. This basically means unless you actually understand what call options are, you're not likely to actually go out and buy one. And now let's look at option probabilities. Weigh the potential risk of your trade against the potential reward using our option probabilities tool built right in the option chain, making it clear that there's a lot of technical analysis that goes into an options trade. And then finally, people having fun. Oh, people having fun right here. Options trading basics. You're in tune with the basics of trading, so you're wondering if options may be right for you. Want to learn about trade options? Start here. Look before you leap into options contracts. Know your contract specs. To be fair, this still makes options seem too fun. This is still too fun. I would say TD Ameritrade is making this seem like it's a fun little endeavor and not just very dangerous charts that can make you lose a lot of money. So what is the point of this pretty damning, once again, I usually say darning, but this is damning, guys. This is trying to prove something for Robinhood and every other company that relies on PFOF, payment for order flow. The meme stock phenomenon in the markets today results from the dangerous intersection of poor investor education by some brokers and payment for order flow practices that exist on and off stock exchanges. These practices create a massive incentive for such brokers to sell their client orders and to sophisticated trading firms uniquely tooled to profit off of them. This is a needless conflict that can harm retail investors and it degrades the integrity of the market ecosystem as a whole. PFOF is a flawed and conflict-ridden practice. Can it be banned? That's for you to look into. However, as a minimum, we believe the SEC's transaction fee pilot should be reinstituted and that it should include all market centers, including exchanges, ATSs, and non-ATSs. This pilot would be an elegant way to test the effects of these conflicts of interest on a market quality as a whole for all investors. So, I promise you guys pretty pictures. Hopefully you got what you were looking for. Does this make sense? Can we take away one of the only ways that Robinhood makes a buttload of money and still assume that the brokers are going to be free in the future? Can Robinhood still sustain the fact that, you know, if we take away PFOF, one of the only ways that they are misaligned with our incentives, but at the very least they're making lots of money and making it free for us to purchase, can we do that? And what are the other downhill repercussions? If you guys believe that this is the only way to go, just like this this analyst here believes that this is the best way to make the entire market more free and equitable, then you should go down in the comment section below and tell me what you think. Go ahead and hit that like button to learn a little bit more about the stock market by showing this to the apes out there who want to learn and grow just like you. And once again, remember, always do your own research. I'm here to make it your very first step in learning about the markets, the up-to-date information, the news that you need, but it is not everything that you have or even partially enough to make financial decisions. I'm not a financial advisor, but I will see you in the live stream tomorrow. And for now, not for forever. Hope you have a nice day.